3 months ago, before the effects of COVID-19 were really felt in the US and many other countries around the world, Tesla released its first quarter earnings figures for the year. At the time, Tesla met Wall Street expectations for revenue and exceeded expectations for earnings, turning a small profit of 9 cents per share using the GAAP accounting method. While its Chinese gigafactory had been forced to close down for more than a month because of the effects of coronavirus in China, Tesla had managed to fare far, far better than many other automakers during the same quarter. Back then, on April 29th, Tesla was trading at a heady $800 per share. Today, it's nearly double that, closing at $1,592.33. And tomorrow, it's likely to go up like a balloon because Tesla has just released what amounts to being a thoroughly impressive second quarter earnings report. Despite the challenges of COVID-19, an impending global recession, and uncertainty over just how bad things will get as coronavirus continues its reign of terror, Tesla beat every expectation of Wall Street analysts. It reported its fourth straight quarter of profits, and much more. So let's get stuck in with those figures, as well as share some of the snippets we learned from the Tesla earnings call. Traditionally in the past, when we've covered Tesla's quarterly earnings on this channel, we've tended to cover production and deliveries first, and so we will here. And were it any normal quarter in any normal year, we'd frankly be a little disappointed with the figures. But in this case, I think we should be super impressed. In total, during Q2, Tesla produced 6,326 Model S and Model X combined, and 75,946 Model 3 and Model Y combined. This represents a 59% and a 13% drop respectively over the first quarter, and an overall reduction of 20% fewer cars in the second quarter when compared to the first. Yet, we need to remind ourselves that Tesla's Fremont factory was closed all the way from March 23rd through until mid-May, or at least it was closed for regular production line stuff. Essentially, Tesla didn't make a single car in Fremont from the start of the second quarter until nearly halfway through it. A 20% overall reduction in vehicle production when compared to the previous quarter, and a 5% reduction compared to the same quarter last year, in those circumstances is frankly astonishing. During the second quarter, Tesla managed to deliver 90,891 cars in total, which was actually up 3% over the first quarter. The lion's share of these were, of course, Model 3 and Model Y deliveries, with Model S and Model X only accounting for 10,614 of those cars. Because Tesla delivered 8,619 cars more during the quarter than it actually made, its global inventory dropped from 25 days worth of cars at the end of the first quarter to 17 days worth of cars at the end of the second. This isn't necessarily a bad thing though, as Tesla can keep a lean supply of cars, and this means it's going to have less of its funds tied up in stock. And in the coming months, Tesla is going to have a fair few number of projects to spend money on. Before we detail those though, let's look at some of the other statistics from Tesla's earnings report. In addition to the cars made and delivered, Tesla deployed a total of 27 megawatts of solar projects during the quarter and 419 megawatt hours of energy storage products. Solar figures are down 23% on last month, while storage deployed is up a massive 61%. And if you think about it, that actually makes a lot of sense, since many of Tesla's solar products end up on residential roofs, which, because of COVID, are not being installed as quickly as they might otherwise be. But Tesla's energy storage products, well, they also include large-scale storage products, in addition to those residential units. And those large-scale projects have been deployed throughout the quarter, especially as some of them are in countries that are less heavily hit by COVID than the USA and haven't suffered a slowdown. Most importantly, Tesla's Megapack storage products turned a profit for the first time in the second quarter. Since Tesla's energy storage business, which actually includes its Autobidder energy trading platform, is expected to expand to be as large, if not larger, than its automotive portfolio in terms of revenue, this is very important news indeed. Despite COVID, we learned through the earnings report that Tesla managed to increase the number of supercharger sites throughout the world by around 6%, while also expanding its store, service and mobile service provision by a total of 2%. Which brings us to those numbers. Despite Tesla suffering a bit of a hit in terms of production during the second quarter, its automotive sales revenue was up on the previous quarter at $4.911 billion. Its total revenue crossed $6 billion, while Tesla's gross profit sat at a healthy $1.267 billion. This all resulted in a quarterly net profit using the non-GAAP method of $2.18 per share, or 50 cents per share if you're using the GAAP method of accounting. That's significantly up on last quarter and isn't far off the figures that Tesla achieved at the tail end of last year. Compare this to what Wall Street actually expected, which was a profit of 3 cents per share. I think you can agree Tesla's doing just fine. Tesla's shareholder letter also detailed some of the progress being made on its various production facilities around the world. It laid out Tesla's current production in Fremont, which is about 490,000 vehicles per year. It laid out the 200,000 Model 3s currently being made per year at Giga Shanghai. It even shared a photograph of equipment being installed at Giga Shanghai ahead of the start of Model Y production there later this year. Tesla also noted that it will expand Model 3 and Model Y production lines to a total of more than 500,000 cars capacity per year at its Fremont facility this year. In fact, those upgrades are already underway in case you're interested. It also stated that its Giga Berlin was proceeding apace. As to the US factories, well, we actually heard more about that during the earnings call beyond what was detailed in the shareholder letter. So let's go there. Specifically, the news that Tesla has now confirmed that it will be building its Tesla Gigafactory in Austin, Texas, at the site within the Del Valle School District that we've all been reporting on for the last few weeks. I've heard it called both a Tesla Gigafactory and a Tesla Terafactory, in case you're interested. What's more, though, Elon Musk confirmed during the call that this brand new factory, worth more than $1 billion to the local economy, will be home to the Model 3, the Model Y, and the Tesla Cybertruck, as well as the Tesla Semi Class 8 big rig. And according to Musk, construction is now already underway. While he didn't elaborate on this, I guess we're talking groundwork now, rather than physical building construction. In addition to all of the above, Elon talked quite a bit to the company's future products, hinting that we're going to see quite a lot of cool stuff on the Battery Day later this year. Assuming, of course, it goes ahead as planned on September 22nd. And although Tesla does have that day to expand on its battery technologies, Elon did note that Tesla is asking mining companies to mine more nickel at pretty high volumes in order to push a new nickel-based battery pack for the Tesla Semi. Meanwhile, he hinted that a new lithium iron phosphate cell would be pushed for all of Tesla's passenger vehicles, resulting in the standard low-end entry-level Teslas having a range in the 300 miles per charge region. Elon Musk also confirmed what lots of people had been curious about, the fact that yes, there will be a compact vehicle of some kind to be made in the near future. We've already seen some supposed sketches flying around the internet, but nothing has been firmly confirmed yet. As for the final vehicle that we do know is coming, the second generation super high performance roadster, well, that, says Elon Musk, could be made in California in the next year to 18 months. At this point, I do feel obliged to point out that Elon is pretty notorious for being overly optimistic with timelines, but still, given Tesla's massive expansion in production capabilities, it now at least looks far more plausible than it was a year ago. Unlike previous quarters, where Tesla had some significant uphill struggles to deal with, it seems that now Tesla's biggest hurdle looking forwards is getting all of those new factories off the ground and up to speed, while keeping its workforce healthy and free from COVID. And I think as the most valuable automaker in the US, it's also time for all of us to treat Tesla like a full-grown, full-size automaker. It is no longer the startup that we all had to treat with kid gloves. And that is fantastic. In fact, all of this good news means that I think Tesla will likely see a spike in share prices tomorrow to well above $1,600 per share, perhaps even $1,700 or $1,800 per share. Recent share prices have already triggered a second series of reward tranches set up to reward Elon Musk for his work at the company. And frankly, I don't expect that third to be far away. So far, Elon's rewards are in the form of stock options, which he will be able to buy at $350 per share. So far, those options are worth an estimated $2 billion, assuming Tesla's share price stays constant in the 5 years that Elon must keep them between buying them and selling them. And no, I don't believe he's exercised his right to buy those options yet, nor do I think that the share price will stay the same over 5 years. Simply put, this is, I think, the most bullish quarter that Tesla's ever had, with the fourth straight quarter of profits, putting it on the fast track to join the lauded list of companies on the S&P 500. Tesla is most certainly here to stay. Shorts be damned. That's it. Thanks for joining me, and I'll see you next time.